नमस्कार। हर संडे की तरह आज भी आपके साथ जुड़ चुका हूं। पिछले 2-4 महीनों से एक सब्जेक्ट जो दिमाग में चल रहा था वो ये था कि lot of bankers were asking me questions about the ARC provisioning and the concepts thereof, like NBV and all those concepts. Along with that, there were questions on the presentation and disclosure, as also a couple of audit points. So today, for the next 4 Sundays, I have with me Mr. Dhananjay Gokhale, who is a chartered accountant and a practicing chartered accountant, and is associated with the institute on various forums, various committees, and delivers several sessions to banking fraternity. He is basically into bank audits. So that enables him to be a perfect person to throw lights on a couple of conceptual clarity subjects which I intend to take up today. So the today's session, this Sunday's session, will be focusing on the ARC SR and related issues. Although there are a couple of videos which were done earlier on the same subject, but then today being a final day in terms of concluding your audits, these concepts maybe run over the 4 Sundays will enable you to understand what kind of errors you should not make, as also what are the things which you need to ensure for the statutory audit. Starting this Sunday, I will be taking up these subjects with him, and then will be beneficial to the entire urban cooperative banking fraternity and bankers in general. Sir, thank you for joining our channel. And to start with, there are a couple of key questions in respect of transfer of loans to ARC. The circular which came in 2021 was after the Supreme Court judgment in the February 2021, wherein the Reserve Bank of India issued master directions on transfer of loans. The circular is somewhere around 70-80 pages, but there is only one page which is killing the urban cooperative banks, that is clause 77. Of course, we will be talking on that clause also. But before we do that, I would like Mr. Dhananjay Gokhale to respond to the background of transfer of loans, the ARCs, and whether it is really beneficial in terms of the provisioning norms which have been introduced by Reserve Bank of India. These are the queries. Initially, I would like to warm up the session on his ideas and thoughts on this subject. Yes.
Yeah. See, as far as ARC concept is concerned, when RBI has introduced that concept, the main intent was to clean off the balance sheets of the banks, especially with respect to the NP accounts, which was kind of a burdensome part on the bank's balance sheet. So the concept was that the banks will hive off the NPAs to ARCs, which are kind of a specialized units or specialized companies who will deal with recovery part, and bank will be relieved from certain sticky loans. So whenever the bank will sell off NP accounts to ARCs, those will go out of the books of accounts of the bank, and there will be multiple methods to sell off the NPAs. But ultimately at the end, it was more of cleaning of the balance sheet. Benefit for the bank was to ensure that the balance sheet is cleaned in terms of reduced NPAs. And apart from that, there was a kind of add-on benefit, which was not really the intent of that circular, but the add-on benefit which was ripped off almost till recent time was more about the postponement of BDDR in terms of the NPAs which are sold off to ARCs. So the real intent was to clean off the balance sheet, and practically we are seeing that it was having a dual content, to clean off the balance sheet and also to postpone BDDR to certain extent legitimately without violating any RBI norms. So that was the background of this circular.
Sir, there are quite a few concepts about which confusion still prevails, and this confusion will start from how to sell and what are the preparatory stages. And while we go for the preparatory stages, how do you arrive at the net book value, how do you use your BDDR, and how do you resort to the valuation of asset that is required to be sold, and how do the ARCs decide the values while purchasing. So these are the 3-4 areas which have been causing virtual havoc because urban cooperative banks clinically do not understand. So that's where I would request you to throw the light on these conceptual ideas.
Actually, just to start from right from the beginning or inception, I should say. Firstly, the bank should prepare their own policy as far as sale of NPA assets is concerned. So, board approved policy is the starting point. Now, once you have the board approved policy, it is expected that the board approved policy will contain certain basic details apart from other details which are already there in the master direction. That it has to be transparent in nature. It should give scope for any ARC to bid for that sale of ARC, sale of NPA concept and all those things. So, firstly, board approved policy has to be there. Once you have board approved policy, second step is that the bank should be able to find out or they have to identify the assets which they intend to sell. Practically, there is no bar on which NP should be sold. Only bar on UCBs is that you cannot sell off performing assets, unlike commercial
Sir,
banks.
I have a question. I'll
Yeah.
interrupt you wherever. To relate to the questions which have been asked to you,
Yeah.
what should be the contents of this board approved policy? What are the key features
Yeah.
which should be a part of your? नहीं तो क्या होगा? People will simply import the RBS guidelines in the board approved policy. That is not going to help.
Yeah.
So, what they should be doing?
Yeah. See, ideally, the board approved policy, apart from major points which are there in master direction, it should contain how the tendering of this ARC or sale of NPA accounts to ARC will happen. What will be the process of bidding in terms of probably, for example, just to give an example, a bank might say that suppose only 2 bids are received, we want to go again for another bidding. Another bank will say that that is not required, even if 2 bidders are there, that is sufficient. So what is really required is that there has to be a fair play as far as the sale of NPA accounts are concerned. In the sense, bank cannot have a policy wherein board will decide as to which ARC will have this NPAs purchased from the bank. So board needs to draft a policy about the standard operating procedures on 2-3 counts. One is that the process of bidding, that is a natural thing. Second is they need to also draft about what is the process of identification of NPAs which are required to be sold off. And then there has to be a procedural guideline as to who will be the person who will be identifying the accounts, who will be the person who will be confirming that these are the accounts which are required to be sold off. Now these 2 points which are vital from board approved policy. Apart from that, the actual action, that is when the bidding process will start off, it needs to be ensured that if anyone is asking you to again kind of demonstrate before them, means any regulatory authority or auditor or for that matter any external person, the bank should have enough documentation to prove before any authority that the process was carried out in a transparent manner. So it's more of practically kind of rewinding and playing the entire SOPs which are there. So if documentation is not there, there are high chances that you might get caught on a wrong foot. Another thing is that whenever the bidding process is undertaken, there has to be a person who is designated, or I should say a couple of persons who are designated, who will be always present at the time of that process. A fair play will also include that ARC's representative is also called for that tender opening process, because it's typically a sealed envelope which ARCs will submit. But prior to that, typically ARCs will first like to do a due diligence of the accounts which are selected by the bank. Now, when you are talking about due diligence, couple of precautions which the bank has to take is, firstly, they have to take a non-disclosure agreement from the ARC, because you are disclosing your loan portfolio or disclosing each and every information to the ARCs. And technically, you are not supposed to disclose this information other than for a specific purpose. So, the NDA should speak about that. Secondly, it might happen that the ARC might back out after due diligence process. So, even if they back out, it practically doesn't hamper your process. So once due diligence is carried out, ARCs typically reach a stage where they calculate that what can be a prospective price which they can pay to the bank. And the prospective price is depending upon certain factors. Firstly, in due diligence process, they carry out legal due diligence also and financial due diligence also. Now, what does this mean actually? Legal due diligence will be carried out to ensure that there is an enforceability of document. The banks are able to recover the outstanding amount by way of sale of underlying securities. As far as financial due diligence is concerned, they will have a fair estimate as to what is the expected timeline when these underlying securities can be sold off. And secondly, what will be the fair value which they can estimate that at which the underlying security will be sold off. And based on that, they will arrive at the present value, factoring with a discounting factor, which typically is the capital deployment. In the sense, suppose ARC feels that say 24% is my capital cost, and let's say 100 rupees are recoverable. That's what is estimated. So if you arrive at today's value, by simple arithmetical means, it will be 76 rupees as on today, that is day 0. So based on certain permutation combination, they will arrive at the price. Now once the price is arrived at, there are other factors also which will matter. So first is the management fee to manage those assets about the recovery process. Second will be maybe an incentivization scheme wherein early recovery might enable them to earn additional amount, which is fair for both ARCs as well as for the bank. So all these factors are considered when ARC will tender for this sale of NP accounts. And based on multiple factors, you will get multiple tenders. Now the challenge before bank is there might be a case wherein you cannot correlate to tenders which are filled in. Just to give an example, let's presume that the prices are different which are quoted, but the incentivization and management fee structure might be different. So here it will be ultimately the banker's call, firstly to decide what is a fair amount or what is the best amount out of that. Second, better option is that you can bring all ARCs at par by telling them, kind of a standard condition that presume that management fee is only at X amount, presume that at Y percentage is your incentive, maybe 1 year, 2 year, 3 years early recovery. Then you get a perfectly comparable price, because otherwise comparison of price becomes a challenge, because every ARC will quote in a different way. Just to give an example, suppose the ARC is giving you say 80 crores for a portfolio, other ARC might be giving you 75 crores, but first ARC is charging you higher management fee, which eventually will recover that 5 crore difference. Now then ultimately you as a bank has to also have a judgment as to what is the probability of recovery. So it's either way, one is that you need to take a judgmental call, or you have all ARCs fall in one line, have an open tender process, in the sense after the sealed envelope is open, you can kind of negotiate in a public forum and arrive at the best price, and that will be the price at which you can fetch a better deal.
No, there was recent guidelines to the ARCs that they cannot recover upfront management fees, and it has to be recovered only from the recovery proceeds for the assets that they have acquired.
Right.
Because there were instances where in the initial phase when banks sold the NPAs, they paid upfront management fee, which was a violation of Reserve Bank of India guidelines. Even in the old 2014 circular, that was not mentioned. So payment of management fees in advance is not correct. It has to be recovered by the ARC from the proceeds of recovery cell. My question is, we put up a tender, we invite all the 27, 28 ARCs.
Yeah.
Everybody bids, but the price is not acceptable to us. What next? Can we, my question is, can we enter into a private agreement with ARC for a price of our liking? Is it advisable or is it feasible? Because the tendering process has failed. I have to sell the assets so as to reduce the gross NPA.
Yeah.
ये प्राइवेट सीसी प्राइवेट ट्रीटी करके बेच सकते हैं क्या नॉन परफॉर्मिंग एसेट्स?
That is something which is not really advisable, for the simple reason that you cannot substantiate as to why that X amount was arrived at. So a better deal, so to say, is that when you are opening those envelopes and let's say that it is an upset price, below which the bank doesn't want to sell off, the bank can be vocal. They might talk with each and every ARC on one-on-one basis. So it need not be a public forum kind of a thing. And then note down or minutize the discussion which was there. Let's say 5 ARCs are there. Bank negotiates with 5 ARCs in different cabins. Everything is minutized, and then whatever is best, the bank goes for that. So it's a kind of a balancing act. So firstly, you have called for a tender. The tender is not meeting your criteria. Criteria in the sense your expected price. So you enter into a one-to-one negotiation. Ask them to improvise on that. Minutize that, so that suppose out of 5, say ARC is selected, you need to have a justifiable reason as to why you selected A and not B. So ultimately, it will become only a question of whether you want to have one-to-one dialogue or whether it is 5 ARCs together bidding. Advantage of having a one-to-one dialogue is that there cannot be any carteling, or there cannot be any hand signs or face signs which might get triggered off. At the same time, important factor is that you need to document all these things. Means one shouldn't be able to make any allegations on you that you have favored a particular ARC after all ARCs have failed. You had a preset kind of you can say understanding with the ARC, and then you have entered into the private deal. So that will become hazardous for the board actually. So better to have a transparent system. Everyone is given the opportunity to meet that expectation. If one of them meets that expectation, nothing like that.
There is one more critical area and which the banks are failing to understand is there is a net book value which is arrived at on the basis of principal minus provision that is carried. But then these ARCs go for a different NBVs.
Yeah.
How do they do that, and should the bank accept it?
See, actually what ARCs are doing, as we discussed earlier, they are arriving at expected price. In the sense expected realization, and they arrive at a present value of that. That's what their starting point is. Typically what ARCs are doing, which doesn't have any regulatory basis actually, they compare the net book value which bank is carrying and they try to correlate that, which doesn't have any base. Just to give an example, suppose say asset is in substandard asset category. So typically my net book value will be 90 rupees after 10% of
Provision.
BDD. Now as compared to that similar asset, maybe in a week's time it will fall into a DA1 category, which will warrant a higher provision of 25%. Now in that case, one cannot say that on a particular date because it was 90, I was ready to offer say 85, and now after a week it is say 75 as a net book value, so I am offering you 70. But somehow the practice which is faced by the banks is more akin to the fact that ARCs keep on comparing the net book value. ARCs are not ready to even take a call based on pure due diligence process, wherein suppose the banks tells them that the account is having so and so legal documentation, other things, you arrive at the price without asking us the rate of NPA. ARCs are typically not ready for that, for the reasons which are best known to them. It's a kind of negotiation tool, I should say.
But then when you give them data, you give all the entire data, so they know what is the status of the account,
Exactly.
at what stage the account is.
I agree.
So they are well aware of it.
They are aware about that, and they are taking disadvantage or advantage, whatever I will say, based on that, because it cannot hold any merits that just because my asset is getting downgraded, maybe a week's time, in a month's time, my value shouldn't be changing.
One more question I would like to ask is that if the asset is required to be sold to ARC, the Reserve Bank of India guidelines typically say that it should be without recourse.
Yeah.
What it means?
Yeah. Actually, what RBI is intending to tell to the bank is that it shouldn't be a kind of a temporary arrangement. So when RBI is saying that it has to be without recourse, it means that the risk, responsibilities, realization, and every benefits, risk, reward, everything gets transferred from bank to the ARCs. Even though we are calling it loosely as ARC, in real parlance, it's a special purpose vehicle, wherein bank has a stake and the ARC also has a stake. So you are passing on the risk, reward, and responsibilities to that particular SPV. And once you do that, actually, it has to be without recourse, because otherwise the practice will start off that bank for a temporary period, they will pass it on. So they will clean off their books. They will again roll it back to the bank's book. So maybe that is the intention, but ultimately it's a regulator's guideline wherein they are saying that it has to be without recourse. So it's a without recourse thing.
Yeah. Now there are two methods of selling to ARC. One is cash basis. What is that? And then there is 1585 formula.
Yeah.
What is that? So the difference between the two and which the bank should prefer, which formula bank should prefer.
See, as far as cash basis is concerned, it's a relatively simple term that you sell off your NPS to ARCs. You don't hold any stake in that subsequent realization. So the ARC will offer you all cash kind of a deal wherein the cash is paid upfront to you, and then whatever risk and rewards are there, they belong to ARC. You don't have any stake on that. So just to take an example, suppose say 100 crore assets are sold off to ARC, against which let's say 75 crores is my provision. So net book value is 25 crores. ARC offers me say 10 crores against that. It means that whatever ARC will recover, maybe beyond 10 crores, they will take a profit out of that. If they recover less than 10 crores, loss also belongs to them. I am not party to that anymore. So I will take an upfront hit of 15 crores because that's a shortfall, and that's it. After that, I don't have to bother about that. So that's a cash sale. If I get say 30 crores instead of 25 crores net book value, presuming that your assets are good, you can book 5 crores of profit, and 30 crores is the value which you have realized.
When you go for 1585 sale, 15% is the contribution given by the ARC and 85% by the bank. The 85% by the bank comes by way of SR, where the loan account gets transferred to investment portfolio SR and your loan account is closed. This accounting is popularly known to everyone, but the recent master guidelines has introduced a clause 77 which talks critical about this provisioning of SRs. Of course, subsequently on the 28th June, Reserve Bank of India granted relief to make SR provisioning within 5 years' time. So, how do you view this clause 77 and its impact on the urban cooperative banks, and what urban cooperative banks should be really doing?
Yeah. So, firstly about this 1585 formula, it's a traditional presumption that it will be 1585. In fact, earlier RBI had mandated that minimum 15% stake has to belong to ARC. Master direction and missed that out. Having said that, most of the banks and ARCs are following the same concept of 1585. So, concept has continued. Now, in 1585 is there, what it really means is this special purpose vehicle which is formulated, out of that ownership content in that special purpose vehicle, 15% will be owned by the ARC, 85% will still belong to bank. Now, as far as the accounting related part is concerned, if you take a simple example, that say suppose I am having assets of say 150 crores which are sold off, that is ledger value of that account, and let's presume that 50 crores is my BDDR. So my net book value is 100 crore. So if I receive anything which is less than 100 crore, let's presume I receive 80 crores. So out of 80 crores sold, 20 crores is my upfront loss, which I need to practically book. And out of 80 crores sold, 85% belongs to me, 15% belongs to the ARC. So as and when recovery happens against that 80 crores, it will be apportioned between two parts, 85 and 15. Prior to that, the success fee, which is in the form of two forms, one is administrative or management fee, which will be taken. Secondly, there might be an incentive structure for early recovery. So those will be recovered, and after that 1585 formula will work out. If it is sold off beyond book value, that is say at 110 crores if it is sold off, out of that 10 crores, what is really realized as of now is only 15%, because 85% still I am only holding. Only nature has changed, but I haven't realized that. So 15% is something which I already parted away with. That is the risk and rewards related to 15% are parted off to the bank. Once I say that it is parted off to the bank, out of 10 crores, 15% can be taken to your P&L account because it's a gain for you. For balance 85%, you need to wait for that actual realization. So that's how the accounting will happen as far as the value is concerned. That is the face value of SR is concerned. Now later on what will happen is, once that is settled in your books of account, it will form part of your portfolio because it is a security receipts. It's an investment which is nomenclatured or classified as a non-SLR security at par with any other non-SLR security, and normal valuation norms will really apply to that. So the first norm which is applicable for that is based on NAV, which is published by the ARCs. So NAV, when it is published by ARC, you need to compare that with book value, and difference will be considered as depreciation or appreciation. And similar to non-SLR security valuation, idea requirement will keep on fluctuating. At the same time, you need to also understand that idea related to any other non-SLR security, it will get squared off against this non-SLR also, because all non-SLR are at par. So suppose you are having a corporate bond which is appreciated, and suppose you are having a SR which is depreciated, knocking off is very much possible.
Because it is in the same group.
It is in the same group, so you can do that. Coming to clause 77, and now it has been amended at 77 and 77A, even though the contents remain same. What RBI has warranted to the bank is, whenever you are having a higher exposure, under only one SR, not ARC, but it's based on SR. So suppose you are having say 5 SR. 5 SR are totaling to say 500 crores. So 10% of that will be 50 crores. So any singular SR or a singular transaction, I should say, either way, if it is more than 50 crores, then this 77A is invoked. Now what that clause is specifying is, they are specifying additional valuation norms. They are not talking about any provisioning norms, they are talking about valuation norms. So the first common norm is NAV based, which is understandable because we have that in mutual funds also. Now the second valuation clause, or added up valuation I should say, is subject to additional criteria. Now that criteria is that RBI is asking the banks to do a valuation based on presumption that suppose the advances were continued with the books of accounts and there would have been a BDDR provision. So RBI is asking you to arrive at net value, which will be ledger value minus BDDR, presuming that it is continued. In the sense, you need to continue with the security value and you need to continue with the date of NPA. Arrive at the net value, that is net book value. So NAV or this net book value, whichever is lower is the concept for valuation. Now once I say it is valuation, it doesn't make any sense to say that it is a provision. It's more of a IDR concept because you can have different methodologies for valuation. So one of the methodology was NAV. Now this is the second methodology, which is a kind of a, you can say, conservative approach. Now once this provision is made, then that provision will ultimately reach to such a stage that you will have to make 100% provision. The moment asset reaches to a D3 stage, there are a couple of challenges in that also. Challenge is that presuming that if my asset is continued in my books of accounts, typically the banks will keep on doing the security valuation, which will not happen with ARC. You don't have privy to that also. So you will always presume that whatever valuation report you had earlier, that will simply get continued. And on that presumption only you will continue that. You will not again go back to ARC and ask them for valuation for natural reason because now the asset doesn't belong to you. But that's what the impact of 77A. And the relaxation which RBI gave, that relaxation is that when the circular was rolled out in September, at that point of time, what RBI has stated is, on that particular date, whichever SRs you are holding, you need to calculate this additional impact of valuation because of this clause 77. That additional impact, that is the difference between NAV and this net book value, that impact you can stagger it over next 4 years. Sorry, next 5 years, 20 years each. Now there is a hitch in that. The hitch is that it's only confined to a stage at which the SRs were there on September. That is on the date of issuance of circular. So let's presume that on that particular date, the asset was sold and that on that date the asset is still in D1 category. Presuming that it is fully secured, you will make only 25% provision. Because provision in the sense valuation, because the dent in valuation is only 25% for DA1. Later on, it will go to D2 and D3, wherein staggering is not permitted. So it will instantly amount to additional provision in that. So maybe next 2 years time only you will get into 100% category. So it's not blanket 100% which can be staggered. So it's not like NAV and 0 and you stagger it. It's only valuation and the adverse impact which you can stagger.
This is precisely where the confusion still prevails, and that confusion is that what bankers are asking question is this: the color of the asset has changed from loans to investment. For investment, if the SR is required to be placed in AFS, I have to make a 5% provision in addition to the NAV based provision that is required. So these two valuation processes are there because SR is in investment. Let me finish the question. Now, despite that, I have to assume, had the account remained in my books, I have to make the provision. Now, this assumption based provisioning which doesn't exist, how do the banks do on, I mean, as you rightly said that if the account is migrating to D3, you are not going to get the latest valuation of asset. So you are subjected to that. Don't you think these anomalies are there and these anomalies are required to be viewed differently? I mean, how do you view the whole scenario?
I will just put it in a different way. First thing is that valuation norms are prescribed by the regulator. Now these are norms which are different from financial valuation norms. That is the first thing. It's a special kind of a you can say a methodology which RBI has prescribed as a regulator. Because in normal financial parlance, such kind of valuation don't exist. You can have a valuation concept wherein NAV calculation method can be prescribed. In fact, just to be more vocal, the guidelines are for the bank and not for the ARC. So ARCs will keep on doing that on NAV based method. Banks will keep on doing that on other method, that is clause 77. Now, one point which is very important is that the staggering of 20% itself is questionable as far as accounting standards are concerned. Accounting standard don't permit any staggering. That's the basic.
मर जाएंगी बैंक अगर 100% करने लगेंगे तो banks will get killed.
No, but that's what the accounting standard says.
And precisely here the let me interrupt you for a moment. Precisely here the question comes up. I sell asset within 5 years, I have to recover. Otherwise, since I have sold it without recourse, it will come via IDR because ARC will return the asset कि भाई मैं ये इसको बेच नहीं पाया. This is one part. I am having an option of extending the period to 8 years. So, day 1 to day 8, 8 years. 8 years is a period from the date of sale where I can complete the provisioning for the entire ARCs that I have sold. Here is sudden jump in that provisioning which possibly I will have to do in the 8th year. How do you view this?
Again, to repeat actually, the provisioning after 8 years, that is something which was coming out of the circular. In the sense, circular never defined that it should be staggered in 8 years also.
It was there in the original guidelines, 2014 as well as 5 years and extendable by 3 years.
Right. So the guidelines were they were focusing on staggering. So there was a sudden fall in or sudden requirement of IDR concept was still there also. In the sense, Suppose I may say 5 years of ARC, that is 5 years SR is there. At the end of 5 years, there was a sudden 100% provision which was required. So sudden provisioning requirement was there earlier also. Only thing different thing which has changed is now it is suddenly been erupted for the SRs which were procured earlier with certain presumption that I have to make a provision after 5 years. So the budgeted figures might vary suddenly. Having said that, I will like to again repeat the another point. Staggering of provision of any nature is something which is against the accounting standard. No accounting standard supports that.
But then no accounting standard also supports to provide for something which is not in the books.
Accounting standard, what it says is, as far as investments are concerned, the accounting standard talks about the valuation methodologies. In valuation methodologies, there are clauses which say that typically the financial models are followed, like say non-SLR. But ultimately, even for non-SLR, when we are talking about taking a risk-free return and adding the risk basis point, it has a basis. So CCL and RBI are typically, the agencies who are saying that how to value that. Now here, as a regulator, when the regulator gives you a method for valuation, it's a valuation method. Now, once the valuation method is given, you cannot deviate from the accounting standard. Because valuation methods per se, RBI is never saying that it has to be staggered. So it's not a valuation method. It's a relaxation which RBI has given. Just to compare it, earlier there was the impact of increased gratuity provision, wherein RBI permitted the banks to stagger it in next 3 years or 5 years, whatever is the case. I mean, this staggering happens actually, it's a complete contradiction to the accounting standard. It's a violation of accounting standard. And per se, I have never read anywhere that the accounting standard can be deviated for a particular industry. Just to give on a broader
So you mean to say even here the 20% relief that has been granted is a deviation?
It's a deviation from accounting standard.
Okay.
Just to add from auditor's perspective, ideally what the auditor should do, because easiest way is to qualify the report, which practically becomes difficult. It's an emphasis of matter para. In the sense, you need to emphasize that this is the regulator's guideline, and because of which the bank has staggered that in next 5 years. That's a better way to deal with that. So it's a kind of a balancing act. But technically, if you ask me, it's a deviation from accounting standard, which is not permitted as per RBI circular itself. Because RBI circular says that the accounting standard should be complied. Here, RBI has never stated that under which accounting standard there is a staggering which is permitted.
RBI never stated that hypothetically how you are going to make the provision for the assets which are not in the books.
No, now they have prescribed that's how your valuation should
you are
be
taking
done.
it to the root of valuation, because that is a valuation. You are not saying that it's a provisioning. Exactly. It's a valuation, and therefore it doesn't affect the
nomenclature of provision which is going to be made. It is in the nature of investment depreciation reserve and not BDDR.
Okay, this gives rise to further query that is coming up very aggressively, is that I do ARC provisioning based on the norms which has been prescribed. 20 years provision for the period of 5 years, and my ARC provisioning is complete. The RBI guidance on ARC provisioning does not describe how accounting wise it has to be classified. There is a talk in town that this ARC provision is virtually equivalent to BDDR. Let me finish the question. I know that you have been getting these queries as well. The logic that is being driven is that since the underlying assets, loan assets are being sold, and I am being forced to make a provision for the loan assets, so the ARC provisioning should also qualify for my net NPA calculation, or ARC provision should also enable me to write off certain SRs, in the sense that there is an account where the ARC has settled the account, and there is some balance of residual value of SR that is still pending, that they are not going to recover it all. I should technically provide and you make use of this ARC provisioning there, if at all it is available. So ARC provisioning, whether it is equivalent to IDR, whether it is equivalent to BDDR, can it be used for net NPA? I mean net NPA. It is a broader question that is hotly being debated. So what's the view on that?
See, as far as provision concept is concerned, the provision is related to investments, right? Because ultimately, your sold off assets are represented in your books of accounts in the form of investment and not in the form of advances. So no question of net NPA and gross NPA concept, because you will never include SRs in gross and net NPAs. No bank does that because it's a security. Once you say that, actually, then BDDR per se doesn't apply to any security. So what I change is only a valuation method. Only thing is that it is linked with methodology of BDDR. Now, once that provision is made, what you are comparing is you are arriving at a value based on that para 77.
SR. So this is respect to SR.
Okay. You are comparing with book value. Difference is always IDR. There cannot be any other nomenclature, because not non-performing investment also. So it is not a provision on NPI, because BDDR you have to compare with.
No, the concept of NPI does not arise here because NPI does not have stage-wise progression.
Exactly. That is one. Second thing is that as far as this NPA concept is concerned, when you mark an advance account as NPA, you say that it is a non-performing asset. For SR, by the very nature of that, you never say that it is a non-performing investment. Just to give you an example, no bank has ever disclosed SRs as NPIs, and no one will like to do that. So that is the sole purpose of selling it off to ARC. So when you talk about PI and NPI, SR will always form part of your performing investment. Now, once you say that it is performing investment, by any stretch of imagination also, it cannot be at par with BDDR. Secondly, BDDR concept is only for advances. Even for NPI also, BDDR doesn't exist. It's more of provision for NPI. Now here it's a performing investment. Once it is a performing investment, practically it will amount to investment depreciation reserve, nothing beyond that actually. That's the only way to deal with that.
So there is one question you have not responded. One is the question about SR which is not likely to come back to me, and I am having an ARC provisioning. Can I set it off against the SR which will never be retired in the lifetime?
You mean to say write-off?
Write-off.
See, the moment, suppose, let's take an example, like say residual value is 20 crores. I'm also holding the idea of 20 crores. So it's only knocking off those values. Now, firstly, we need to go to the root cause or reason for that, because what has happened in RBI's regulatory norms is I have never read a sentence anywhere that after expiry period of SR, it should be treated as non-performing investment. That wordings are missing. Though technically it should be NPI, because once your expiry date of
presumptive guidelines that residual SR will enter your books via IDR.
Yeah.
Via IDR. That's how the practically
right. Does. Now we have a scenario wherein let's say SR is expired, or maybe residual value is there which is not recoverable. All assets are sold off and all those things. Against that, you have 20 crores of IDR. One way is that you can simply knock it off and write it off. Still, so, you have that right of recovery intact, which is against that 20 crores of IDR.
But ARC provisioning can be used there for knocking off SR is what you are trying to tell.
Only issue is that you cannot say that it is written off because there is no concept of write-off of ARC SR.
No, we'll not enter into
the more of cleaning of balance sheet.
Yeah. Now, yes, that is possible, but RBI guidelines is missing on that.
Yeah,
they are not saying anything on that.
In fact, prudential right of concept doesn't exist in case of normal investments also. The prudential right of word which is used, it is always used along with advances.
No, but then there were a couple of banks who had invested into the DHFL and ILFS securities, non-SLR bonds.
See, that concept of writing off is a different concept than what we talk loosely as a prudential write-off. Just to give an example, like suppose say in Yes Bank case or any other bank.
The 28,000 crores bonds were written off. Yeah.
So there is no scope for recovery. It's as good as you are
gone. It's gone.
So the wording should be carefully used. You cannot say prudential write-off. The prudential write-off is a different terminology. At the same time, RBI doesn't have any guideline. So you need to be very clear on disclosure part, that your intent and your action both should match. It should be clearly stated in your notes on accounts. Because the biggest challenge which I foresee over here is that whether you can call it as NPI or not. The moment SR expiry period gets over, because then your balance sheet schedules will look different. One cannot interpret from that, and even if you do that as an NPI, better way is that you write it down as a footnote by saying that this belongs to only SRs which have expired. Because otherwise the reader of balance sheet will not understand as to which kind of investment the bank has made. He can misinterpret it that bank is having a corporate bond exposure or any other exposure. So better to be little careful about disclosure part.
There is no clarity on one more aspect also. The creation of ARC provisioning for say next 4 or 5 years, you create a separate ARC pro. What do you do with that?
That will remain.
अरे मेरा टाइम खत्म हो गया, मेरा एसेट वापस आ गया, वो वैसे ही पड़ा रहेगा. It's not contra, it's a hit to my P&L.
So you have taken a hit to your P&L. You have created idea.
Right. No, I have not created idea. I have created ARC provisions. Above the line item, period. Of course, we'll come to that above the line, below the line subsequently. But then it's a clear-cut P&L charge on the P&L.
It is a charge on P&L. It is a provision on SRs. But ultimately, the disclosure is idea. There cannot be any separate line item.
नहीं, मेरे को ये समझ में नहीं आ रहा है सर. सीधी बात है कि मेरा ARC प्रोविजन हो गया, मेरा ARC SR भी नहीं बचा, ARC प्रोविजन करके मैंने लॉस खा खा के ARC का प्रोविजन बना लिया, क्या करने का उसका बाद में जाके?
It will be equivalent at par with your SR value, book value.
SR value is zero now, it is
SR value
gone.
will not be zero. SR you
Will
have
be
to do
zero
book value.
after the tenure is over, say 5 years tenure. समझो मैंने 100 करोड़ का SR मेरे बुक्स में है, मैंने 100 करोड़ का प्रोविजन किया, मेरे को 50 करोड़ का रिकवरी आ गया, 50 करोड़ का SR वैसे ही पेंडिंग है, तो वो SR और ये ARC प्रोविजनिंग नेट ऑफ से उड़ नहीं जाएगा, क्योंकि बचा ही नहीं ना कुछ उसमें.
There is an option for banks to do that. That's what I'm saying. That the word of prudential write-off will not per se apply, but bank can give a disclosure by saying that since the
We knock it
expiry
off.
is over, we are knocking it off. But your wording should not be prudential write-off because it's not an advance.
Okay, it's not an advance. I got it. There is one more concept which is moving around the town, and there are a couple of chartered accountants who are doing this. They have been talking to banks. तुमको ये ARC का प्रोविजन आ रहा है ना SR पे, तुम्हारा हम SR बेच के देते हैं. Selling of your SR to some other ARC, selling of your SR to some other bank, so that your SRs are out of your book, and then you don't have to make a provision. How do you view this?
Actually, I don't think that such clauses really exist.
It doesn't prohibit. RBI's guidelines nowhere prohibits resale of SR.
SR sale concept itself is not there in the circular.
No, it's an asset. It's a security paper. The moment it's a security paper, it is a tradable commodity. So I have traded my SR for a compromise, for a cut price, reduced my SR, sold it to someone, some vulture funder who can take this SR and still further recover the money. Can that be a way out?
It's more of just a claim actually that they will be able to sell off the
Yeah.
It's nothing beyond
अरे
that.
दुनिया भर में क्या हो रहा है, क्लेम तो बेच रहे हैं.
No, it's not that way actually. Selling off of SR concept is practically inexistent as far as.
Where is the question of being unethical?
No, it's not about that part, but in regulatory guidelines.
There are no regulatory guidelines, therefore the question is.
Exactly. So if there are no regulatory guidelines, we need to see that what kind of SR contract you are entering into, are they transferable? Now, just to go a little further, just to getting into a different mode.
The moment security receipts are, let me interrupt. Moment security receipts are issued, it becomes a tradable commodity because it's a security receipt recognized separately from each ARC. As an instrument, I can deal with it. Is the common banking practice. Not that regulatory guidelines are not there. I agree. What is the window out of this?
Even though you are saying that it's a banking practice.
No, it is no practice. It's not practice. It is the hot discussion that is taking place.
At times, first thing is that as far as these claims are concerned, there has to be firstly someone who should be ready to purchase a SR.
Let's keep that aside because there are भाई सर ऐसा है कि कमर्शियल बैंकों को स्टैंडर्ड एसेट बेचने की भी मुभा है. स्टैंडर्ड एसेट ले सकते, कमर्शियल बैंक्स स्ट्रेस्ड एसेट ले सकती है, कमर्शियल बैंक्स SR भी ले सकती है मार्केट में. तो ये अगर होता है तो डोंट यू थिंक द बैंक्स व्हिच आर स्टक विद
those are not applicable for UCB.
So that's the issue. I mean, the guideline should come for UCB.
UCB and commercial banks are not at par as far as the circular is concerned. Many paras are.
अच्छा, मैं फिर से एक बार पूछता हूँ और एक सवाल जो मैंने आपको ऑलरेडी पूछा है, फिर भी दिल के करीब है इसलिए पूछता हूँ. ये जो ARC प्रोविजनिंग है, इसका नेट NPA के कंपटीशन के लिए इस्तेमाल कर सकते हैं क्या, हाँ या ना? ओके. आपको क्या लगता है, क्या स्ट्रैटेजी अर्बन कोऑपरेटिव बैंक्स ने ARC सेल के बारे में यूज करना चाहिए here onward, whether they should go for it, whether they should.
Now what any urban cooperative bank should do is they need to first assess as to the reason why they want to sell off to ARC. The only possible reason or the only possible justification is to clean off your balance sheet, nothing beyond that. You shouldn't be expecting that you are getting away with BDDR and getting a 5 years holiday or postponement. That is no more a case. So that is the first thing which one has to understand. If the reasons are genuine to clean off the balance sheet, that option is already open. At the same time, it comes with a pinch actually, because you might be required to take a upfront hit. There will be management fees, there will be incentives. So mind is to factor in all these things and then only take a call. But it's not a you can say easy dodging of BDDR which was there earlier. That is no more there. Rather, it is now closed. That's a closed window. So only genuine cases which RBI was harping on initially when the ARC concept was launched. RBI never said that it is a tool for postponement of BDDR.
But that was the intent. That was the intent as is pursued by the urban cooperative banks.
That is the intent, or I should say, that is the concept which bankers, considered.
Let's not talk of commercial bank, let's talk of urban cooperative banks.
So that was you can say a fallout or outcome or a benefit out of that.
Yeah, yeah.
Which bankers felt that it's a benefit which is there. RBI always kept on saying that it is cleaning of your balance sheet. So RBI was never into that mode wherein they said that there is a postponement, even though 20% staggering is what they are doing it now. If I compare that with 20% staggering, I will always say that earlier 5 years postponement was anyway there in a legitimate mode, wherein staggering was not there.
Okay.
So it's only getting replaced by this concept. So now it's back to square again.
Yeah. Thank you, Dhananjay. Thank you for wonderful insight. I hope you enjoyed this discussion. Till we meet next Sunday on a similar accounting topic. Keep watching, keep viewing, keep liking. Even if you do not like, you can post comments on that. I thank Dhananjay on behalf of all of you, all my viewers. Thank you so much for joining. Thank you.